Hey everyone. Now, before we dive into today's discussion about why gold keeps going up and whether it's too late to invest, I want to address something important. Over the past 3 days, the price of gold has taken a dip of more than 14%. It's an interesting twist, right? You might be wondering what's behind this sudden drop and whether it's a sign to pull back on gold investments. Well, I'm here to tell you, this might just be a temporary setback in a much larger trend. I've been watching the markets closely, and while dips like these can cause some uncertainty, they also offer a unique opportunity for those who are patient and know what they're doing. Stick around as we break down why gold keeps climbing, even with these fluctuations, and why it might still be the right time for you to consider adding some to your portfolio. I pulled the latest macro data and forecasts, IMF, OECD, World Bank, central banks, national stats, and a few major bank research notes, then write a fresh TTS-ready narration script with inline citations throughout. Opening, the world economy is steady, but the forces underneath are changing. If you only look at the headline numbers, the global economy entering 2026 looks surprisingly calm. Global growth is expected to run around 3.3% in 2026 and around 3.2% in 2027. That is not a boom, but it is also not the synchronized slowdown many forecasters feared when policy rates were at their peak. Source: IMF World Economic Outlook Update January 2026. But steady is not the same as simple. Beneath the surface, the G7 nations are diverging in three ways that matter for the next 6 to 12 months and for the next 2 to 5 years. First, inflation is cooling in most advanced economies, yet the last mile back to central bank targets is uneven. Second, growth is being reshaped by sector-level transitions, artificial intelligence adoption, energy transition investment, and the reconfiguration of supply chains. Third, geopolitics is now a structural variable, not a temporary disturbance, and it is affecting trade, industrial policy, and fiscal choices. In this video, we will walk through a data-driven outlook for the G7, the United States, Canada, the United Kingdom, France, Germany, Italy, and Japan, and we will also connect those outlooks to a few systemically important emerging Tier 1 economies, where spillovers back into the G7 tend to be large, especially China and India. IMF World Economic Outlook Update, January 2026. The goal here is not prediction theater. It is to map what the most credible institutions are forecasting, where they agree, where they disagree, and which risks could shift the path. Current state assessment across Tier 1 economies. Let's set a baseline snapshot with 4 indicators: growth, inflation, labor markets, and interest rates. Growth. Mixed momentum entering 2026. Recent activity data points to a world where growth is patchy, rather than uniformly strong or weak. In the United States, real gross domestic product, or GDP, grew at an annual rate of about 2.3% in the third quarter of 2025, according to the Bureau of Economic Analysis. US BEA GDP news release, Q3 2025. In Europe, Germany's GDP stagnated in the third quarter of 2025, with manufacturing output notably weak. Destatis GDP press release, Q3 2025. France, by contrast, posted a stronger quarter, with real GDP up about 0.5% quarter-on-quarter in the third quarter. INSEE National Accounts, Q3 2025. Italy was broadly flat on a quarter-on-quarter basis in its third quarter reading. Istat Quarterly National Accounts, Q3 2025. In the United Kingdom, monthly GDP rose about 0.3% in November of 2025, following a flat October, suggesting fragile but positive momentum. UK ONS monthly GDP estimate, November 2025. In Japan, official commentary and releases point to a soft patch in mid-2025, though the policy focus has shifted towards sustaining a wage and price dynamic while normalizing rates. Bank of Japan Statement on Monetary Policy, January 2026. Inflation. Closer to target in Europe than in the UK, and still debated in the US. Inflation has decelerated substantially compared with the peaks of 2022 and 2023. But the cross-country picture differs. In the United States, the Consumer Price Index, or CPI, rose 2.9% year over year in December of 2025. US BLS CPI news release December 2025. In Canada, CPI inflation was about 2.4% year over year in December of 2025. Statistics Canada CPI release December 2025. In the euro area, inflation was estimated at roughly 2.0% year over year for December of 2025. Eurostat flash estimate December 2025. In the United Kingdom, CPI inflation was higher at about 3.4% year over year in December of 2025. UK ONS CPI release December 2025. In France, CPI inflation was unusually low by recent standards, around 0.8% year over year in December of 2025. INSEE CPI release December 2025. In Italy, the Harmonized Index of Consumer Prices, or HICP, ran around 1.2% year over year in December of 2025. ISTAT HICP press release December 2025. In Japan, headline CPI indicators remained above zero and near low single digits, with official indicators showing year-over-year inflation around 2.1% in December of 2025. Statistics Bureau of Japan latest indicators December 2025. Labor markets, still resilient but not identical. The United States unemployment rate was about 4.4% in December of 2025. US BLS employment situation December 2025. Canada's unemployment rate rose to about 6.8% in December of 2025. Statistics Canada Labor Force Survey December 2025. The euro area unemployment rate was about 6.3% in November of 2025. Eurostat Euro indicators November 2025. The United Kingdom's unemployment rate was about 5.1% in the 3 months to November of 2025. UK ONS Labour Market Overview Nov 2025 period. Japan's unemployment rate was around 2.6% in November of 2025. Statistics Bureau of Japan latest indicators November 2025. Interest rates. The direction is easing in North America and Europe, but Japan is the outlier. The Federal Reserve held the federal funds target range at 3.5 to 3.75% in December of 2025. Federal Reserve FOMC statement, December 2025. The Bank of Canada's target for the overnight rate stood at 2.25% as of its December 10th decision in 2025. Bank of Canada Policy Interest Rate Table, December 2025. The Bank of England's bank rate was 3.75% following its December decision. Bank of England official bank rate page, December 2025. The European Central Bank's deposit facility rate was 2.0%, reflecting the euro area's move closer to target inflation. ECB key interest rates, December 2025. Japan is the major exception. The Bank of Japan's policy guideline aimed to keep the uncollateralized overnight call rate around 0.75% as of late January 2026. Bank of Japan Statement on Monetary Policy, January 2026. That mix easing in many places, normalization in Japan is one of the defining macro contrasts heading into the next year. United States economic outlook. The baseline. Solid growth, inflation cooling, policy held restrictive for now. On the consensus baseline, the U.S. remains the fastest growing large advanced economy over the next year, supported by household balance sheets that are still healthier than in many peer countries, and by large-scale private investment in technology infrastructure. The International Monetary Fund projects U.S. growth around 2.4% in 2026, a notable upgrade from earlier expectations, partly due to stronger momentum into late 2025. IMF World Economic Outlook Update, January 2026. Inflation, however, is still the central variable. A 2.9% year-over-year CPI print in December of 2025 is materially lower than the highs of prior years, but it is still above the 2% zone that anchors most long-run policy frameworks. US BLS CPI news release, December 2025. 3 U.S.-specific themes matter for the next 6 to 12 months. 1. Services inflation and labor rebalancing. With unemployment around 4.4%, the labor market is not weak, but it is not as tight as it was earlier in the cycle. US BLS employment situation, December 2025. If wage growth decelerates without a spike in job losses, the Fed's soft landing narrative remains plausible. 2. Fiscal gravity. Many institutions emphasize that debt dynamics are becoming a macro constraint globally, not just in emerging markets. The IMF has warned that global public debt is on a path to exceed 100% of GDP by 2029 in its projections, which raises the sensitivity of many economies, including large advanced economies, to interest rate shocks and growth disappointments. IMF Fiscal Monitor, October 2025. 3. Technology capex and productivity. The U.S. is seeing heavy capital expenditure in data centers, chips, and software to support artificial intelligence deployment. The macro debate is not whether AI changes firm-level workflows, it clearly does, but how quickly those changes translate into economy-wide productivity gains. The IMF and other researchers emphasize that diffusion, regulation, and labor market adaptation determine whether productivity gains show up broadly or remain concentrated. IMF Working Paper. The Global Impact of AI, Mind the Gap, April 2025. Medium-term outlook, 2 to 5 years. Over a 2 to 5 year horizon, the U.S. outlook hinges on whether productivity growth lifts the speed limit of the economy. OECD research on AI and productivity in G7 economies specifically highlights that the scale of gains depends on adoption rates and complementary investment, things like skills, organizational change, and infrastructure. OECD Working Paper. Macroeconomic Productivity Gains from AI in G7 Economies, 2025. European economies and the United Kingdom Euro area. Closer to inflation target, but growth is the constraint. Europe enters 2026 with a major macro advantage and a major macro challenge. The advantage is inflation. Euro area inflation is around 2.0% year over year for December of 2025, essentially at target. Eurostat flash estimate, December 2025. The labor market is also relatively stable, with euro area unemployment around 6.3%. Eurostat Euro indicators, November 2025. The challenge is growth, particularly in manufacturing-heavy economies. Germany's third quarter of 2025 showed stagnation quarter on quarter, and the details matter. Manufacturing gross value added fell about 0.9% quarter on quarter, which is meaningful because Germany's industrial base is deeply tied to global trade and capital goods cycles. The Status GDP detailed results, Q3 2025. France and Italy, different mixes of resilience and constraint. France delivered a stronger third quarter, with GDP up 0.5% quarter on quarter, supported by exports and investment. Source: INSEE National Accounts, Q3 2025. Yet inflation at about 0.8% year over year in December suggests a demand environment that is not overheating. Source: INSEE CPI release, December 2025. Italy's third quarter GDP reading was broadly flat on a quarter-on-quarter basis, and inflation by the HICP measure was around 1.2% year-over-year in December. ISTAT Quarterly National Accounts, Q3 2025. ISTAT HICP press release, December 2025. In practical terms, that combination, low inflation and low growth, increases attention on productivity reforms, labor force participation, and investment efficiency over the medium term. The United Kingdom, inflation stickier, growth modest, and policy still tight. The UK's challenge set is different. CPI inflation at roughly 3.4% in December of 2025 is higher than in the euro area. UK ONS CPI release, December 2025. At the same time, unemployment around 5.1% indicates a labor market that is loosening. UK ONS Labor Market Overview, Nov 2025 period. The Bank of England held bank rate at 3.75% after its December meeting, reflecting the balancing act. Bring inflation down without amplifying weakness in growth. Bank of England, official bank rate page, December 2025. Medium-term outlook. Energy, industry, and demographics. For Europe and the UK over the next 2 to 5 years, 3 structural factors stand out. Energy transition and industrial competitiveness. The capital spending required for grid expansion, renewables, storage, and electrification is enormous. Global energy investment in 2025 is projected at roughly 3.3 trillion US dollars, with about 2.2 trillion US dollars going into clean energy. IEA World Energy Investment 2025 Trade and Supply Chain Redesign. Friendshoring, export controls, and strategic subsidies all change the allocation of industrial investment, not necessarily reducing trade, but making it more regional and policy-shaped. Aging and workforce constraints. UN demographic projections emphasize that aging is a dominant long-run force, especially in countries like Italy and Germany, which face rising dependency ratios over time. UN World Population Prospects 2024. Asian powerhouse-focused Japan's distinct cycle. Japan is running a different playbook than the rest of the G7, and that makes it important. Inflation and wages. The policy regime has shifted. Japan's inflation indicators are now consistently above the zero inflation world of the prior decade, with official indicators showing year-over-year inflation around 2.1% in December of 2025. Statistics Bureau of Japan latest indicators, December 2025. Unemployment around 2.6% indicates a tight labor market by Japanese standards. Statistics Bureau of Japan latest indicators, November 2025. Monetary policy, normalization, but with caution. In late January 2026, the Bank of Japan kept its operational guideline aimed at maintaining the uncollateralized overnight call rate around 0.75%. Bank of Japan Statement on Monetary Policy, January 2026. This is a profound shift from the negative rate and yield curve control era, and it changes how Japan transmits shocks into global markets through the yen and through Japanese government bond yields. Japan's central bank outlook documents emphasize moderate growth and a virtuous cycle from income to spending, while also explicitly flagging trade and tariff policy uncertainty as a risk factor. Bank of Japan, Outlook for Economic Activity and Prices, January 2026. Medium-term issues, demographics and debt sustainability. Japan's 2 to 5 year outlook is heavily shaped by demographics and fiscal structure. Aging trends are among the most intense in the advanced world, which affects labor supply, health spending, and the political economy of reform. UN World Population Prospects 2024. At the same time, high public debt levels make the economy sensitive to persistent increases in real rates, which is one reason policy normalization is likely to remain gradual and data-driven. Cross-cutting themes that link the next year to the next 5 years. Theme 1, Artificial Intelligence Productivity Potential, Labor Disruption Risk. AI is both a growth opportunity and a labor market transition. The IMF has highlighted that in advanced economies, roughly 60% of jobs may be affected by AI in some way, ranging from task augmentation to substitution, which implies a large reallocation problem even if the net growth effect is positive. IMF blog, AI will transform the global economy, January 2024. Research also stresses uncertainty about timing. IMF working papers estimate that productivity gains depend on adoption, sector exposure, and complementary investments, with some scenarios implying modest near-term gains but larger medium-term effects if diffusion accelerates. IMF working paper. The Global Impact of AI, Mind the Gap, April 2025. BIS research similarly frames AI as a potential driver of firm-level growth and productivity, while emphasizing heterogeneity across countries and industries. BIS Working Paper on AI and Growth, 2025. In plain language, AI can raise output per worker, but it can also create transition cost training, job matching, and wage dispersion that show up in politics and policy. Theme 2, Energy Transition and Energy Security Investment Boom, Uneven Geography. Energy is no longer only about price levels. It is about reliability, resilience, and industrial strategy. The International Energy Agency projects global energy investment at roughly 3.3 trillion US dollars in 2025, with electricity sector investment around 1.5 trillion US dollars. IEA World Energy Investment 2025. That scale changes macro outcomes. It supports industrial demand for metals and equipment. it pressures permitting and grid capacity, and it interacts with AI because data centers increase electricity demand. Outside the G7, the transition is also reshaping trade patterns. For example, China's clean technology exports reached record levels in 2025, led by batteries and electric vehicles, underscoring how industrial capacity and export competitiveness are now part of the energy story. Reuters Commodities and Energy Analysis, January 2026. Theme 3, Debt and Fiscal Space. The macro constraint that links everything, debt is the quiet amplifier of shocks. When debt levels are high, a small change in growth or interest rates produces a large change in debt trajectories. The IMF projects global public debt rising above 100% of GDP by 2029 under its baseline, with risks tilted to the upside. IMF Fiscal Monitor, October 2025. Separately, IMF monitoring shows that both public and private debt have risen substantially as shares of global GDP over recent decades. IMF Global Debt Monitor 2025. For the G7, the implication is not immediate crisis. The implication is that fiscal choices become more trade-off heavy. Defense spending, climate investment, aging-related spending, and industrial policy compete more directly for limited room. Theme 4, Demographics Slower, Labor Force Growth, Higher Dependency Ratios. UN projections emphasize population aging across many advanced economies, which tends to lower trend growth unless productivity rises or labor force participation increases. UN World Population Prospects 2024. This is one reason AI and productivity are not just interesting. They are central to the medium-term fiscal and growth outlook. Risks and uncertainties. 3 scenarios, not one forecast. No credible forecaster claims a single-path future, so let's frame risks in scenario terms. Baseline scenario: steady growth, easing inflation, gradual rate normalization. This is the IMF-style baseline: global growth in the low 3% range, inflation gradually converging toward targets, and rates easing in many advanced economies while Japan normalizes cautiously. IMF World Economic Outlook Update, January 2026. Upside scenario: productivity surprise and faster diffusion of new technologies. If AI-driven productivity gains diffuse faster than expected across services, healthcare, logistics, and manufacturing growth could run above baseline without re-accelerating inflation. This is possible, but research generally treats it as a medium-term effect rather than an instant one. OECD Working Paper on AI Productivity in G7 2025. Downside scenario: geopolitics and fiscal constraints interact. A negative scenario is less about one shock and more about combinations: trade restrictions plus energy volatility, or higher long-term rates plus widening fiscal deficits. Central banks and international institutions consistently flag these interactions as key tail risks. IMF Fiscal Monitor, October 2025. Conclusion: what the consensus says, where it diverges, and what to take away. Pulling everything together, here is the consensus view across major institutions. The global economy is expected to grow steadily in 2026 and 2027, not spectacularly, but with resilience. IMF World Economic Outlook Update, January 2026. Inflation has largely come down, with the euro area near target, the UK still above, and North America in the late stage of disinflation. Eurostat Flash Estimate, December 2025. UK ONS CPI Release, December 2025. US BLS CPI News Release, December 2025. Labor markets remain relatively firm, but the direction in several economies is gradual cooling rather than retightening. US BLS Employment Situation, December 2025. Eurostat Euro Indicators, November 2025. Monetary policy is moving toward easing in many jurisdictions, while Japan remains in a distinctive normalization cycle. Federal Reserve FOMC Statement, December 2025. Bank of Japan Statement on Monetary Policy, January 2026. Where the outlook diverges most is on the medium-term engine of growth. Optimists expect AI and energy transition investment to lift productivity enough to offset aging and debt constraints. Cautious forecasters argue that diffusion will be slow, that labor market disruption could be politically destabilizing, and that high debt levels reduce room to respond to shocks. IMF Working Paper, The Global Impact of AI Mind the Gap, April 2025. IMF Fiscal Monitor, October 2025. The main actionable insight in the educational sense is that the next year is likely to be shaped by disinflation and policy adjustment, while the next 5 years are likely to be shaped by productivity, demographics, and fiscal capacity. If you understand those three forces, you will understand why different G7 economies can look fine in the short run while still facing very different strategic constraints in the long run. This analysis is for informational and educational purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Economic forecasts are subject to significant uncertainty. Viewers should conduct their own research and consult qualified financial advisors before making investment decisions.